Hello, everyone, and welcome to episode 136 of the Do More with Your Money show. Today, we want to look back on how asset markets have performed over the past week and what has been a very eventful week, particularly for UK markets. I'm joined now by the team to discuss these aspects today. We've got Matt, George, Tom, and joining us from Edinburgh, we also have Kevin. So maybe just to get started, Matt, could you maybe just bring to life for our viewers how asset markets have behaved over the past week or so?
Yeah, absolutely, Jeff. So thanks for having us on. So we think about equity markets this week. That if looking at MSCI ACWI, so that's global equities and emerging markets also added in there, down 1.7% this month, and global bond markets down about 1% as well. But I think for us as the investment team, what's actually been really quite what we've been looking at really quite a lot is the actual volatility within those. So if we look at something like the VIX index, which gives us a measure of volatility within equities, that's picked up back above 30 once again. And the MOVE index, which gives us something similar for volatility in bond markets, has also remained elevated year to date as it has from the inflation pressures and central bank action we've seen year to date.
And those equity numbers you were giving there are sterling numbers.
And they're in local terms. So what we've also got to factor in is just the impact of sterling. So that's obviously weakened following the mini budget, which we're going to touch on later in the episode.
And I suppose, as you've alluded to there, really it's been about volatility, particularly in the UK sovereign market.
Yep.
And maybe just can you give some indication of how yields have moved in the UK market over the course of the week?
Yeah, so hugely volatile since the budget. But actually, we're going to touch on it later on in the episode, but we've actually had intervention from Bank of England, the central bank. So actually what their actions have done is pulled bond yields back in. So they're in about 20 bips this week, as well as US Treasury. So a bit of spillover into other international bond markets, both down about 20 bips.
Okay. And maybe, Kevin, you could maybe sort of help bring to life some of that sell-off in the gilt market that we saw from last Friday, effectively, and really maybe walk through your interpretation of what's happened there and why it's occurred.
Yeah, Jeff, I think if we take it back just to, let's say, to the start of August, yields on government bonds globally were rising as a result of expected Fed tightening. The difference through September is the election of Liz Truss as leader of the Conservative Party and as Prime Minister has crystallised the idea of some form of fiscal stimulus, as well as the backstop of the energy markets in the UK. What has been particularly difficult for the sovereign bond market in the UK, the gilt market, is that the true cost of these fiscal initiatives are unknown. And also the government took the unusual steps of not permitting the Office for Budget Responsibility to effectively cost the exercise and give an outlook for what impact it would have on growth, inflation, and other parts of the economy, such as the jobs market. So we were seeing big rises in bond yields through the start of last week. Bond yields moved very quickly higher when the budget was announced on Friday morning a week ago. And that really continued through Monday, Tuesday, and Wednesday morning of this week, as in effect, and this is highly unusual, parts of the gilt market became untradeable and the market experienced wild swings in prices, which eventually led to the intervention from the Bank of England at 11 o'clock on Wednesday.
And in terms of some of those swings that we were seeing in the gilt market, I think it's really informative if we look at maybe the 30-year and if you can give some sense of how volatile that was in terms of, we often discuss it in yield terms, but it's maybe important for our viewers to think about that in the terms of the price move that we were seeing over the course of those few days.
Absolutely. I think what's important to help our clients and viewers to understand is that a bond has a price. Now, you get a fixed interest or a coupon on that bond, but the way it's traded in the market is via the price. Now, what we saw over the 3 days into Wednesday was that the price of the 30-year UK government bond, the 30-year gilt, fell around about 25% in 3 days. Now, that is highly unusual, and that's what made the market effectively untradable. So pension funds in particular, who have exposure to these instruments, were not able to raise collateral, or were facing, and that is post-margin, or cover some of their implied paper losses. So we saw a big rise in bond yields 3 days into early Wednesday of, in yield terms, 120 basis points. So yields went from about 3.8% to over 5% in just under 3 trading sessions. And then the Bank of England announced that they were willing to intervene. And effectively all of that price fall was taken back. And so we saw yields drop 100 basis points in the space of an afternoon. That is, in price terms, around about a 20 to 25% rise in the price of the underlying bond. So remarkable moves in what is typically being a very unvolatile part of the government bond curve.
And I think, Kevin, that it's a great way to have brought it to life with just the magnitude of those 20% price moves. When we think about that in terms of the assets that we're talking about, long-dated sovereign bonds, we maybe associate a 20% price move with an equity, and even after that, it's probably a company that's had to have a profit warning to see a fall of 20% within it. And I suppose, George, really Kevin's alluded to there that we had to have this intervention coming in from the Bank of England to stabilise the longer end of the gilt market in and of itself. Could you just describe the actions that they took? Because we've spent a lot of time in our podcasts in morning markets discussing really the tightening that we've seen from central banks in terms of interest rate increases, quantitative easing, moving to quantitative tightening, and this seems to be a removal of some of that potentially.
Yeah, of course, absolutely. Thank you, Kevin. Essentially what the Bank of England was seeking to do was provide some stability to the gilt market through monetary intervention. So we've seen a rapid rise in yields on gilts. We've experienced a weakening of the pound through that course of that time, which was essentially acknowledging that the government spending, or fiscal spending as we refer to it, will come from the mini budget, would essentially be funded by creating more debt at a time when the cost of servicing that debt is higher. So that was a recognition from the markets. And as we all know, interest rates have been moving higher through the course of the year after the Bank of England took interest rates down to close to 0% through COVID. They were also buying bonds at that point in time, so buying bonds from the market to ensure that there was liquidity there. What we were actually expecting to see and what was planned to happen was actually selling those bonds from the beginning of next week. So actually reducing the number of bonds which they had on their balance sheet, and the intervention essentially postponed that. So rather than selling bonds from Monday, they're actually going to continue with their support through until October. So rather than selling bonds, they're actually going to be buying bonds, and they've already started doing this, as Kevin mentioned. They announced it around 11 a.m. They were in about the 3 o'clock auction on that day, which was on Wednesday. So buying 30-year government bonds essentially to moderate the yields which we were seeing, provide some stability to the markets. And markets heard what they wanted to hear. That intervention was coming through. We saw rapid moderation in terms of yield. Kevin mentioned around 100 basis points in 30-year government bonds. So that's a bond held with 30 years to maturity. That's a substantial move for a single day. That's eased some of the pressures. There's still some well-publicised examples of where pressures are. You know, the pension funds, which are liability-driven. Also the mortgage market. You know, we've heard well-publicised examples of fixed-rate interest mortgages being pulled or delayed until they get more clarity in terms of where an appropriate level is to set those rates. The ironic aspect is the markets responded so quickly to the announcement at 11 o'clock that by the time the central bank were in the auction, it was actually more expensive for them to be buying those bonds. But that's just an example of how rapid this move has been. So the intervention was there to provide stability to the market, acknowledging rise in government debt levels, rise in servicing costs of that, and a weaker pound overall.
And I think at the moment it certainly has provided that stability to the longer end of the curve. We can see that how it's behaved over the last couple of days. Just to come back to yourself, Kevin, one of the points that George was making there was sort of the unfunded nature of some of those tax reductions and changes in policy that was announced. Could you maybe bring that to life just in terms of the scale of it for our viewers and what that would mean in terms of issuance that could be expected?
Yeah, so I think if we first acknowledge that the UK government or the country has ran a fiscal deficit for part of 21 years, that is, the United Kingdom spends more than it borrows, and it has done for over 20 years. So we were already running a deficit. We were already having to access the gilt market to finance government spending. If we were to take in the energy price cap freeze that the government have pledged, and also the tax cuts, which were costed but effectively were unfunded. There was no offsetting pledge to reduce spending. All in, it could be that the United Kingdom would be issuing £200 billion worth of gilts over the next 12 months. Now, that is the sort of fiscal deficit that we're used to during crisis periods, the COVID furlough period, for instance, and also if we go back to about 12, 13 years to the depths of the global financial crisis when we had unemployment towards 8, 9%. So where the real struggles are, these are almost wartime deficits at periods of full employment. And as George has just alluded to, the extra explosive in the mix was the potential for the bank to be also selling gilts back into the market as well. So adding to that supply of gilts, which could potentially have taken the supply of gilts in the market over the next 12 months close to £300 billion.
Okay, thanks, Kevin. I think that just brings to life really the scale of what we're talking about, and when you do compare it to what we saw in COVID as a percentage of GDP, we were certainly approaching similar levels in terms of that within the gilt market itself, and the support provided by the government. And clearly one of the other things we've seen over the course of this week has been very challenging headlines. We as an organisation have to deal with that, and we use the various forms of communication that we have with our clients, our advisors, to really help them understand what's been happening in markets and why it's been occurring. And Tom, maybe to bring you in at this point, really from an advisor and a client perspective, what are the types of calls that you've been seeing, and have they been reflective of those headlines that we've seen?
Well, we've seen our performance calls go up quite dramatically over the last month. So month on month, they're up 254%. Another area that we look at with these times, when markets are like this, is fund switches, so advised fund switches, and they're up 110% month on month as well. So we're increasingly talking about risk with clients. And I suppose one of the big things that really impacted that was the headlines, which were on Wednesday, with regards to pension funds. Now, it's really important to point out, and I don't think this is what the media didn't point out to clients, is that this is impacting defined benefit schemes rather than defined contribution schemes like True Potential. And I mean, that's quite dangerous, to be perfectly honest with you, because it's not being truthful to the public, and probably not giving the proper facts, and it makes a lot of clients worried, and impact stock markets as well. And again, obviously, this is all due to the type of scheme that we were, the defined benefit scheme, and the type of they were using an LDI, which is a liability-driven investing strategy. And effectively, what they've been doing over the years is buying up gilts. And then obviously, as gilt yields have gone up, the price have gone down, and they've started selling, and that's why the Bank of England had to try and get involved with that. The other headlines that you're seeing in the news at the moment is all to do with mortgage rates. And again, on Wednesday, 50% of lenders were actually not in the market and pulled their fixed rate terms for 2 and 5 years. Again, that's all due to the mini budget that we've seen, and the fact that these lenders are not comfortable with interest rate prices, and now that's going to affect their mortgage rate. It's going to be very interesting over the next 6 months to see what happens with mortgage rates. I mean, I'm unfortunately in the position where I've got to remortgage in July next year, which is when interest rates are expected to peak. And obviously that's a difficult situation for someone like me, where you might have to look at an index, based, sort of tracker mortgage rather than looking at a traditional fixed rate, because it's likely, hopefully, as a result of that, it'll go down over time. But this probably won't impact clients, our clients as much, because it's going to really impact those who are in the earlier term of the mortgage, where you're paying off a substantial amount more of interest in comparison to capital. And as a result of people like myself, unfortunately, I'm going to see quite a substantial rise in my mortgage rate, unfortunately.
And I think you made a very important point there at the outset, that really when I was driving to work on Tuesday and Wednesday, it was very much about this monocle of pension funds and pension assets. And I think it's a great point to drive out that it's very specific to defined benefit and final salary schemes, not at all the defined contribution schemes that we're very much part and parcel of True Potential. So there's very stark differences between those types of scheme.
There is, and the problem is with that is it then causes people to panic in the market, and you can then see selling off in the market.
Was that what you were maybe seeing with some of the client calls, just to inform them that actually it doesn't relate to the scheme in which they're involved?
Absolutely, we just have to calm them down over that, and that was fairly easy to do. It's it's a quick fix really, but at the same time, people who aren't being informed of that and they're just going off the headlines, they could be potentially making decisions which aren't beneficial to themselves just based off headlines and not actually seeing.
So again,
speaking to someone.
Advice is important.
Absolutely.
Using the central advice team, giving a call to your advisor, going and speaking to somebody to understand how it does impact your own personal circumstances is very important.
Yeah, and certainly as well, I think it's important for clients as well who are in the looking at mortgages at the minute, with the mortgage market as it is, speaking to a mortgage advisor, and also probably speaking to a financial advisor if you've got one, as a second opinion in terms of where interest rates are going, because it's going to be certainly a challenging time for those people who are looking to remortgage over the next 6 months.
I don't know, Matt and Kevin, in terms of interest rate expectations, clearly they've continued to really move around to that volatility point that you were making at the start, Matt, that interest rate expectations have been quite volatile as the week has progressed and have evolved both in the UK and in the US over the course of the week.
Yeah, I think, Jeff, if we just focus on the US, the market was fairly certain going into the end of the summer that the US hiking cycle would eventually end around about somewhere close to 4%. Now that's moved out towards 4.5%. So markets are broadly comfortable with the idea that the US will have an interest rate of 4.5% sometime within the next 6 months. The real change again has been the outlook for the UK, where we were looking similarly at a rate of around about 4.5% by next summer. Where we've gone to in the space of a matter of a week is that we could be going as high as somewhere between 5.5% and 6% by early spring. Now, given how quickly things are moving, given how volatile the market I wouldn't place too much weight on that end forecast, but it's highly likely we do see an unusually large increase in interest rates from the Bank of England at their next meeting in early November, such has been the size of the fiscal initiative from the government.
And that's kind of one of the points that I wanted to maybe focus on a little bit. It certainly seems that the bank's chief economist over his past two times, he's been speaking Northern Ireland last night and then earlier in the week, certainly suggesting that we should expect an outsized potential increase to interest rates when we look to that November meeting.
Yeah, and I think the reason why November is so critical is it's a meeting which in the schedule from the Bank of England fits with their refreshed forecasts and projections for the outlook of the economy. So if we cast our mind back to early August, with the last vintage of forecasts, they were fairly bearish on the outlook for the UK economy, but they were rather adamant that interest rate rises were still appropriate given the outlook for inflation. Now, we have had the fundamental shift in the energy price cap freeze, which effectively ensures that inflation should fall quickly as we go through the end of October into the rest of the year and then through into 2023. And in fact, we may actually see inflation close to target within the next 12 to 14 months, which is wonderful news for the Bank of England, but they are trying to manage the uncertainty in the economy, which has full employment and now has these tax cuts likely to drip through, although most of them are backloaded to April next year. So that November meeting appears now nailed on as saying potentially an interest rate increase from somewhere between 1% to 2 percentage points added to the existing interest rate of 2.25%.
And I suppose the thing there is that the market is effectively moving to try and price that. So we're getting through some of those expectations. They're becoming the reality, if maybe that's one way to think about it, because it's already what's in the market. Matt, the other thing that we've seen really over the course of really the year has been the implication that this has had for sterling in terms of the backdrop that we've been discussing. And volatility has been sort of the name of the game in many assets, and certain sterling has been another one of those assets that we've seen that over the course of the year and over the last few days as well.
Yeah, absolutely, Jeff. So, sterling, especially after the mini budget, has really been very volatile. And really, it's going to have big implications for businesses, as Kevin's mentioned before, the weaker currency, given the structure of the UK economy, net importer, it's likely going to bring through higher business costs and add to businesses' cost structures, so likely to weigh on profits for companies, but also Bank of England likely, as Kevin's mentioned, where markets are pricing interest rates, banks are going to try and defend the currency, so you're also going to have a second wave coming through from those higher rates of interest. But we're likely actually with UK companies to see a bit of a difference between the performance of the domestic side and the FTSE 250 and the international and the FTSE 100, because those companies in the FTSE 100, more global in nature, likely to be earning some of their revenues in overseas currencies. So actually, once you get that translation effect, so selling things in US dollars, euros, pulling it back into sterling, given the weakness that we've seen, that's likely to give their earnings a boost. And sort of the other thing that we're thinking about as well is just what potential impact that has on the M&A activity in the UK, given once again sterling weakness, overseas buyers find those companies cheaper, more attractive to buy. But also if we think about price to earnings multiples for equities, UK just got written down here, it's trading at a 45% discount to US equities. So if you're a US business, you'd be thinking, well, the currency's cheap and the equity's also cheap. So
there's a double opportunity potentially for US companies looking at UK enterprises effectively.
Yep.
I think the other thing that I suppose is really important to think about there is that the weaker currency presents opportunities internationally as well in terms of international investment. The True Potential Portfolio Solution is very much exposed to global factors as opposed to just UK factors, and we'll maybe come to that just in a minute. But I wanted to bring Tom in on just really that volatility that we've been discussing. Matt's talked about it in the currency, Kevin in the bond market, etc. What have we been seeing? I'm sure some clients have said, well, maybe I should just be in cash at this point in time. How would we respond to that from a client point of view?
Yeah, absolutely. I mean, the problem with going in cash is you crystallise your losses that you've potentially made there. The worst time, if anything, really is to be cashing out. When the market's going down or when they're low. Now, what clients often come and say to me is, well, can I cash out and then come back into the market? Well, what you're trying to do there is time the markets, and that's such a difficult thing to do. And it's not something that we advise any clients doing at all. I mean, we found that with COVID, when we were going through the COVID, bear market then, a lot of clients, because it moved so quickly, and when it did recover, missed out on the opportunity to come back into the market, and as a result of that, they really lost out and came off much worse and just remaining invested throughout the whole journey, really. So that's always our advice. It'll be any advisor's advice in this situation, is just to remain invested. It's not easy. We completely understand that.
And I suppose we got an indication of the problems that the volatility creates earlier in the week when we saw the 30-year gilt moving from that 4% level back down to, or 5% I should say, back down to the 4% level. That magnitude of move can have quite significant implications as well.
It can, and it's obviously certainly scary for clients that you're speaking to, and we completely understand that. But I think one of the key things with a lot of our clients is they are invested in pension funds. Pension funds should be invested for the rest of your life if you use it properly. So therefore, people often think, it's not a long-term investment. I'm going to retire in a couple of years' time, but even when you retire, those funds are still invested, and they're with you for if you use them properly for the rest of your life. So you've got plenty of time to let it recover and come back.
And I think therein is a really important point as well, that they're invested for the long term, but they're also very well diversified. So whilst we're focusing in our discussion at the moment on a very narrow part of the the asset market universe, it's been crucially important this week. But George, maybe turning to you from a TPP perspective, the True Potential Portfolio Solution, they're very well diversified, and indeed our exposure to gilts is a few percentage points in the balanced portfolio if we look at it that way. So
Yeah,
maybe
absolutely.
you can sort of bring the discussion to how we think about portfolios, how we think about the multi-asset proposition, and the role that they provide within this type of an environment that we're seeing.
Yeah, absolutely. I mean, diversification's been our approach since day one. It's what we firmly believe in. And for context, we focus quite a bit on morning markets and on today's session of a particular asset class being UK government bonds or UK gilts. That represents about 4% of our balanced portfolio for context. We do hold exposure to overseas government bonds, but as Kevin highlighted, they have not been held to the same level of volatility as we've seen here in the UK market. So diversification is very important, not just in terms of core asset classes, but also within those asset classes. So looking internationally from fixed income and looking internationally from an equity perspective, and also alternatives. Alternatives, an example of an asset class which we can use to take a directional view. So for example, some of the strongest performing alternative products we've held through the course of this year have actually been short government bonds, short equities at a time of those challenges.
Can you maybe just bring to life what short means just for our viewers?
Yeah, absolutely. So you can take a traditional long position, which is buying on the expectation of a rise in price, or you can take an opposite position, which is if you expect a moderation in terms of that price and profit from that change in that price movement. And
so
these strategies,
those trend products have benefited from that because of the falling bond prices that we've seen, or falling equity prices.
Exactly, yeah. So they've provided a positive return, which has helped us diversify some of the challenges which have been faced in traditional investment asset classes.
And we work with many different managers across the globe. And maybe how does that process work? What's been some of the key areas that we've been discussing with those managers in recent days? There's a great question from one of our viewers, just really wanting to understand that a little bit more.
Yeah, absolutely. I mean, multi-asset investment management is about finding the opportunities and balancing out your risks. So in terms of balancing risks, our managers have got less equity than what they came into the course of the year with, so they've been more cautiously positioned. They're holding bonds which are less sensitive to these rising rates, and they're holding those alternative instruments which we've just highlighted can offer you that positive return within your multi-asset investment portfolio. The type of companies that they've been holding and having a preference for has been those which are more defensive in their nature, so bigger companies, stronger balance sheets, better positioned to weather challenges of rising input costs is an example there. But we made the point earlier that the reaction is often delayed relative or ahead of what you're seeing within the market. So the gilt market, as an example, has priced in a lot of the expected interest rate hikes, which aren't expected to really wash through until spring. So markets are always expected to move ahead of what you see in the real economy and in terms of policy. So on that basis, we've seen a significant amount of action in terms of asset class performance through the course of the year. And that's put valuations in a better position than what they were. Remember last year we were talking about headlines saying certain markets are overvalued. Well, a lot of those markets relative to their own long-term history have cheapened up. So for a multi-asset investment manager, it's about being very careful, very careful in terms of what you're buying, when you're buying it. But those valuation opportunities are now better than what they were at the beginning.
That certainly was something that we were discussing as a team just yesterday, and Matt and Kevin very much were leading that conversation. Could maybe both of you bring to life a little bit about maybe how valuations have changed in areas that you're seeing opportunity within the growth aligned product range that we run ourselves here?
Absolutely, Jeff. If you just focus on fixed income, given it's dominated the narrative so much, certainly the corporate bond market in the UK is showing valuations that we haven't seen since prior to the global financial crisis beginning 2007, 2008. Now, this is debt issued by corporates who are not necessarily based in the UK, but they do issue it into sterling markets. And the yields available on those bonds are now in the region of 6 to 7%, which is as I said, we haven't seen for about 15 years. So and these are very short-dated duration instruments. That is, the interest rate risk within the bond, the sensitivity or the volatility is very low.
And just
So
in terms of, sorry, Kevin, just in terms of the duration, it's one of the terms that we use, but for our viewers, what does that just mean in terms of the bond market?
So that's just the sensitivity to the change in outlook for interest rates. So very crudely, if you had a 2-year bond and the yield on that bond changed by 100 basis points, you would lose 2%. However, if you owned a 10-year bond and the yield on that bond moved 100 basis points higher, you would lose 10%. So it's that sensitivity as you go further, you go up the yield curve, the further you go out in maturity, the more your price swings are susceptible given the underlying move in yield. So you can protect your portfolio somewhat by moving down the yield curve into shorter duration instruments, particularly when the valuations, as we discussed there, are so attractive.
And that's certainly been something that you've been doing within the growth aligned range, something that's certainly also been visible within the True Potential portfolio solution.
Yeah, and I think the other thing as a broad headline takeaway from that discussion that we had was actually the relative attractiveness of bonds compared to equities has started to shift a bit. So in that sort of post-financial crisis world, the relative attractiveness favoured equities, but actually, given what Kevin's pointed out there before, we're actually starting to see that shift a little bit, where actually fixed income instruments are starting to look relatively more attractive compared to what's on offer from equities.
And therein, I suppose, the beauty of multi-asset, that you're able to go and look for those opportunities with our managers within the asset universe, effectively.
I think that's it, and hence the reason why, for example, when you do get announcement that central banks are going to tighten their interest rate policy, faster than expected, we're not coming in and overhauling our portfolios. Why? Because we've been having these conversations and discussions with our managers and product providers for 18, 24 months. We've been in a very low interest rate environment with very loose monetary policy to get us through the pandemic. We knew that the tightening was going to come, so we've been positioning our portfolios accordingly. And it also comes back to diversification. Gilt volatility has been evident and key focal point through the course of the week. But what's our portfolio exposure? It's around 4% within the balance. So it's all in context, and it's all, markets will move ahead of the data and the policy, and it's our job to get on the front foot there.
And I think, Tom, to bring you in on that, a number of the questions that we've certainly seen on the coming through is, well, should I move into a single asset class? Should I move into cash, or should I move just into to government bonds? What is your sort of thinking around that from an advice point of view?
The advice point of view is just no, because from our side of things, you want a diversified portfolio. You want fund managers who are actively looking at the environment. They've got a lot of data there to see what the best decisions need to be made in terms of changing the asset allocations within the portfolio. If you do that, you've got real issues of having much more volatility within that portfolio because you've only got one asset class there, and you can't move freely to the ever-changing environment that's taking place at the moment. So certainly in an environment like that, the answer is, you should be multi-asset, really.
Yeah, and use diversification
Exactly.
to your advantage. Well, hopefully that has brought together a number of the questions that you, our viewers, have been asking over the course of the past few days. And we've certainly covered a lot of ground in the discussion today. But as always, if you require more information, please do go and seek it from Tom and the rest of the team from an advice perspective. But also look at the True Potential YouTube channel, where you can see morning markets on a daily basis, and we'll keep you up to date with how markets are evolving. Many thanks for joining us.
Subscribing to the True Potential YouTube channel is quick and easy. Simply go to the channel on your desktop or through the YouTube app on your phone and click the subscribe button. You can then press the notification bell symbol if you wish to be notified as and when new videos are released. Doing this is a great way to keep yourself updated with market developments and personal finance insights. Thank you to everyone who has subscribed, and we look forward to continuing to help you do more with your money.